Today's tech news moves fast, but understanding it shouldn't be hard. That's why Snarful Solutions Group brings you Connecting the Dots, where we break down what's happening in tech and why it matters to you. Now, let's dive in with your hosts.
We all grow up learning these unshakable laws of physics.
Right, yeah. Like gravity.
Exactly. Like in nature, the massive whale always swallows the tiny minnow. And in computing, progress has literally always meant building smaller and smaller chips to get faster results.
Oh, absolutely. Moore's law, right? Shrink it down.
Shrink it down. And in business, we're taught that technology just seamlessly crosses borders to conquer the globe. But, and this is what we're getting into today, what happens when you wake up one morning and realize all those laws of physics have just suddenly reversed?
Man, it creates a serious sense of vertigo, honestly. I mean, the strategies that built the biggest companies in the world over the last 20 years, they suddenly look completely obsolete.
Yeah, completely.
The map we've been using just no longer matches the territory we're actually standing on.
And, well, helping you navigate that strange new territory is exactly what we do here. So welcome to Connecting the Dots, the daily radio show where we break down the most consequential tech news and figure out its real everyday impact on your life, your work, and your wallet. I'm your host, Alex.
And I'm Morgan.
We are broadcasting today from the Snarful Solutions Group in Sacramento, California, and today is Monday, May 4, 2026.
Beautiful morning for it, too.
It really is. Before we get into these massive shifts happening in retail and global computing, let's quickly set the stage for the day. Looking out the window here in Sacramento, it's a pretty comfortable morning.
Very nice.
Yeah, sitting at 64 degrees Fahrenheit with a light 7-mile-per-hour breeze. Though, we might see some light rain later. Nationally, though, it's a bit more turbulent.
Oh, yeah, definitely.
There are nearly 300 active U.S. weather alerts right now. About 89 of those are over land, so definitely keep an eye on weather.gov if you're traveling today.
Well, that turbulence is actually a really great metaphor for the financial markets right now, too.
Oh, for sure. How are we looking?
So if you look at the major indices, you're seeing just a lot of mixed signals. The Dow closed down on Friday at 49,499.27.
Right.
But, and here's the catch, if you step back and look at the whole week, it secured solid gains. And the S&P 500 did the exact same thing. Slight daily dip, but a weekly gain. It's that classic push and pull.
Meanwhile, the crypto space is just leaning entirely into the pull.
Oh, big time.
Yeah, Bitcoin opened this morning over the 78,000 mark.
Wow.
I know, right? And it's up over 4% for the week. There is real momentum building in digital assets. And, that mix of traditional market tension and digital momentum brings us perfectly to the mission for today's show.
Let's hear it.
We are going to look closer at 3 massive tech stories from the Morningstar Tech Report. These are actively shifting the balance of power in retail and artificial intelligence right now.
Yeah, these aren't just, boring boardroom dramas.
Exactly. These are moves that will dictate how our families shop, how professionals work, and honestly, what the global tech ecosystem looks like by the end of the decade.
Absolutely.
But first, let's pay the bills with a quick break.
That's good.
Today's episode is brought to you by Strong Coffee, the premium instant coffee that tastes like a traditional brew but is packed with 15 grams of protein, NCTs, and adaptogens like ashwagandha. Get clean, sustained energy without the jitters. Use promo code SNARFUL for 20% off at strongcoffeecompany.com.
All right, so let's unpack this first story because it has absolutely sent shockwaves through Wall Street this morning.
Shockwaves is an understatement.
Truly. GameStop, yes. The mall-based video game retailer has made an unsolicited $55.5 billion takeover bid for the e-commerce pioneer, eBay.
Okay, we really need to pause and just absorb the sheer absurdity of those numbers.
This is wild.
They are offering $125 per share, right? In a 50-50 split of cash and stock.
Yep, that's the offer.
My initial reaction to this was just complete disbelief. We're talking about a minnow trying to swallow a whale here.
Oh, completely.
Going into Friday, GameStop had a market valuation of roughly $12 billion.
Right.
And eBay is sitting at about $46 billion. So I have to ask, is this just leftover, 2021 era meme stock hubris, or is there an actual grounded business logic here?
Well, it's incredibly tempting to dismiss it as a meme stock stunt. Everyone's first thought was, here we go again.
Right.
But when you look at the actual term sheet that GameStop CEO Ryan Cohen is presenting, the math is shockingly sober.
Really?
Yeah. Cohen hasn't just issued some flashy press release. He's quietly built a 5% stake in eBay already.
Wow, okay.
And he is threatening to take this hostile if the eBay board rebuffs him. Plus, he's backed by a $20 billion bank loan from TD Securities.
Wait, hold on. A $20 billion loan from TD Securities. That's real money. Getting a loan like that from a major traditional bank means the adults in the room have looked at this and signed off. So what is Cohen's pitch to the banks? I mean, how does a $12 billion company justify buying a company 4 times its size?
So, the core of his argument rests on this ruthless $2 billion cost-cutting plan.
Okay.
He essentially believes eBay has become super bloated and just lost its identity over the years. Specifically, he is pointing a massive spotlight at eBay's marketing and sales budget.
Which is how much?
In 2025, eBay spent $2.4 billion in that department alone.
$2.4 billion on just marketing. What did they get for that? I mean, what was the return on investment there?
Well, according to the letter Cohen sent to eBay's chair, that $2.4 billion spend resulted in a net increase of active buyers of just 0.75%.
You've got to be kidding me.
Nope. In raw numbers, they spent $2.4 billion to acquire barely 1 million new active users.
Okay, wait, let me do that math in my head really quick. That means they paid roughly $2,400 to acquire a single new user.
Basically, yeah.
On a platform where people are mostly buying, like, secondhand clothes and used electronics, that is a staggering customer acquisition cost.
It's completely unsustainable.
So his argument is basically, you are a legacy internet brand with near universal recognition. Why on earth are you spending billions on digital ads that clearly aren't working?
That is exactly the crux of the financial argument. So he wants to slash $1.2 billion directly from sales and marketing right off the bat.
Makes sense.
Then cut another $300 million from product development and shave $500 million from admin departments like HR and IT.
But, I mean, you can't just cut your way to growth, right?
Right. And Cohen knows that. The cuts are only half the strategy. The other half, which is the actual growth engine, is what GameStop brings to the physical world.
And this is where the story shifts from, a Wall Street spreadsheet to our actual neighborhoods.
Exactly.
Because GameStop still has about 1,600 physical retail stores left, right? After spending the last few years closing down all the underperforming ones.
Yeah, about 1,600 locations.
So under this proposal, those 1,600 stores wouldn't just be selling video games anymore. They suddenly become this massive physical nationwide logistical network for eBay.
Precisely. Think about the biggest friction point of using eBay for the average person right now.
Shipping or getting scammed.
Both. It's the logistics and the trust. Cohen envisions these physical stores as national drop-off and shipping nodes, but more importantly, he's focusing on authentication.
Oh, that's huge.
Right now, if you buy, say, an expensive trading card or a vintage watch or high-end hardware on eBay, there's always that lingering fear, right?
Yeah, that it's counterfeit.
Exactly. But GameStop's retail staff already inspect, grade, and authenticate used hardware and collectibles every single day. That's their core business.
Okay, so imagine the practical application here for a family or a small business. You have a rare collectible. Instead of taking photos, writing a long description, hoping buyers trust your zero review profile, and then dealing with buying shipping materials.
Which is a huge hassle.
You just walk into your local strip mall, you hand the item to a human being behind the GameStop counter, they verify it on the spot, and boom, your eBay listing is instantly generated and it carries a guaranteed trust badge.
It's seamless.
Yeah.
And they're even proposing using the backrooms of these physical stores as live broadcasting studios for high-end auctions.
That is so smart.
It really is. It is a direct play to build a legitimate structural competitor to Amazon.
Which is incredibly hard to do.
Right, because Amazon dominates due to its incredibly dense multi-billion-dollar logistical network. Building that from scratch today is nearly impossible.
Yeah, nobody has the capital for that.
But this combined entity, it would merge massive digital reach with an immediate pre-existing physical footprint in almost every community in America.
That would fundamentally change how everyday families interact with online resale. Though, I mean, eBay's leadership isn't just going to surrender without a fight.
Oh, definitely not.
I saw they just reported first quarter revenue of $3.09 billion, which actually beat Wall Street's expectations.
They did beat expectations, yeah. And eBay's current strategy is essentially what Cohen is trying to interrupt. They've been trying to buy relevance, basically.
How so?
Well, acquiring companies like the secondhand fashion app Depop for $1.2 billion just to capture younger demographics.
Right.
And crucially, eBay actually credits their recent Q1 success to leaning heavily into artificial intelligence. Specifically, they're using AI to drastically improve communication and search matching between buyers and sellers.
It's fascinating that eBay is relying on AI to save its margins. But, that software reliance exposes a massive physical bottleneck for the entire industry.
Huge bottleneck.
Because the AI that eBay and everyone else wants to use requires immense computing power.
Yeah.
And right now, we are hitting the absolute physical limits of how small we can shrink traditional silicon chips to power those systems.
Yeah, physics is undefeated.
Exactly, which is why this company called Cerebras is trying to solve the problem by going in the exact opposite direction. Let's talk about the startup baking a giant pizza to take on a $3 trillion king.
Man, it is one of the most audacious hardware swings we've seen in decades. Cerebras is an AI chipmaker, and they're launching their second attempt at a U.S. initial public offering.
Okay.
They are seeking a valuation of up to $40 billion, aiming to raise roughly $3.5 billion by selling 28 million shares priced between $115 and $125 a piece.
Okay, I really want to explore the physical hardware here, because it feels counterintuitive to literally everything we know about computing.
It really does.
For decades, like we said, Moore's law dictated that progress meant making chips smaller and packing more transistors into a tiny space. Most people think of a computer chip as a tiny little square of silicon, like a single slice of pizza, right?
Sure.
Nvidia's flagship B200 chip, which powers most of this AI revolution, is essentially just a really, really powerful slice. But Cerebras isn't making a slice. They are baking an entire massive table-sized pizza.
That's massive.
Their flagship processor, the WSE3, is the largest commercial silicon chip in the world. It is 58 times larger than Nvidia's B200.
58.
I have to ask, though, if bigger is better, why didn't Nvidia or Intel do this years ago?
Well, the reason nobody did it is because of the manufacturing defect rate, which the industry commonly calls the yield problem.
Okay, the yield problem.
Right. When you manufacture silicon wafers, there are always microscopic flaws, just part of the process.
Yeah.
Traditionally, you make a large wafer, and then you slice it up into hundreds of tiny chips.
Oh, I see.
That way, if there's a microscopic flaw on one part of the wafer, you only throw away the one tiny slice that contains the flaw, and you keep all the rest.
Right, you save the good slice.
Exactly. But if you try to make one giant chip out of the whole wafer, a single microscopic flaw could ruin the entire multi-million-dollar piece of hardware.
So how did Cerebras fix that?
They figured out a proprietary way to route around those microscopic defects on the fly, allowing them to keep the entire wafer intact.
Okay, so they solved the manufacturing hurdle. But why does the giant pizza approach actually make the AI faster, like physically?
It all comes down to latency. The time it takes for data to travel. Think of those standard chips, the single slices of pizza. If you need to feed a massive AI model, one slice isn't enough.
Right, you need a lot of...
You have to wire thousands of those slices together. So the data has to constantly leave one chip, travel down a copper wire, and enter another chip.
Which takes time.
Passing that data back and forth creates a massive traffic jam. But because Cerebras bakes an entire table-sized pizza on one continuous piece of silicon, the data never has to leave the chip. The communication bottleneck just disappears.
So the AI gets its answers almost instantly.
Exactly.
But let me push back here for a second. Nvidia is a $3 trillion absolute juggernaut. They essentially built the modern AI era from the ground up. Is having a physically larger chip really enough to dethrone them?
See, that is the $40 billion question right there. And answering it requires us to understand a crucial distinction in how artificial intelligence works. The difference between training and inference.
Okay, break that down for me.
Cerebras is not actually trying to dethrone Nvidia entirely. Nvidia completely dominates the training phase. That is when an AI model is essentially going to school. It's reading the entire internet, learning the patterns, and building its neural network.
Got it.
That process takes months and requires massive clustered arrays of traditional GPUs.
So if training is the AI going to school and reading the encyclopedia, what is inference?
Inference is when the AI actually takes the test.
Oh, I like that.
It is what happens when you sit at your desk, you type a prompt into ChatGPT, and you wait for the answer. That is the AI applying what it already learned to generate a response for you in real time.
Okay, so inference is the everyday usage.
Exactly. And Cerebras is carving out a stronghold, specifically in the inference market. Their massive chips are uniquely designed to provide incredibly fast memory bandwidth, which is exactly what inference requires.
And clearly, the major players believe in this approach, right? Because Cerebras just secured a transformative deal with OpenAI.
Oh, it's huge. A multi-year compute agreement worth more than $10 billion.
Wow.
They are providing up to 750 megawatts of computing power through 2028. Just to put that in perspective, 750 megawatts is enough electricity to power a medium-sized city.
That is unbelievable.
For a company that generated $510 million in revenue in 2025, which, by the way, was a 76% jump from the previous year, swinging them into a $238 million profit.
A huge leap.
Landing a $10 billion contract is totally game-changing. It serves as an anchor that proves to Wall Street they are a serious infrastructural player.
It's an incredible turnaround, especially considering they had a major geopolitical roadblock recently. I mean, their first IPO attempt back in 2024 was actually halted due to national security concerns, right?
That's right, yeah. The Committee on Foreign Investment in the United States, or CFIUS, stepped in.
Why did they intervene?
Well, the issue was that Cerebras' largest customer and a major shareholder was G42. They are a massive tech conglomerate based in Abu Dhabi. And at the time, G42 had deep ties to Chinese partners. At one point, G42 accounted for 87% of Cerebras' revenue. The U.S. government was very worried about advanced U.S. chip technology bleeding into China through the Middle East.
So what did Cerebras do?
They had to pause the IPO, wait for G42 to divest its Chinese investments, and convert their holdings to non-voting shares. They finally cleared that hurdle in March 2025.
It's wild to think that a tech startup in California had its IPO paused because the Middle East has become a proxy battleground for the tech war between the US and China.
It really shows how connected everything is.
But the geopolitical tension isn't just affecting startups. It is causing massive headaches for the biggest players in the world. Which actually brings us to our third story, the tech Iron Curtain.
Yeah, and this is arguably the most profound shift in global commerce we've seen this decade. Nvidia CEO Jensen Huang recently announced that his company's market share of AI accelerators in China has plummeted to 0%. 0%. Just 2 years ago, analysts estimated Nvidia controlled roughly 66% of that massive market. Now it's completely evaporated.
Okay, going from 2/3 of the market to absolute zero in a country the size of China is staggering.
It's unprecedented.
And Hong isn't blaming a competitor, is he? He is placing the blame squarely on U.S. export policy.
Correct.
He's saying the government restrictions meant to keep advanced chips out of China have largely backfired. It feels like the ultimate textbook definition of the Streisand effect.
Oh, absolutely.
By trying to choke off China's access to our cutting-edge AI hardware, we didn't stop them from wanting it or needing it. We just gave them the ultimate financial and strategic incentive to build their own alternative faster than they ever would have otherwise.
Yeah, it essentially acted as a massive protective tariff for Chinese domestic chip makers.
Wow, yeah.
Huang argues that by conceding a market of that scale, the U.S. basically forced companies like Huawei, Cambricon, and more Threads to accelerate their own self-sufficiency.
Have they actually caught up?
Well, tech research firm Bernstein estimates these domestic vendors are now moving to cover up to 80% of China's total demand. Huang stated bluntly that conceding an entire market the size of China probably does not make a lot of strategic sense, and that U.S. policy needs to be dynamic.
I understand the hardware side, for sure, but I have to ask about the software. Because I thought Nvidia's real secret weapon wasn't just the physical silicon, it was their software ecosystem. Specifically CUDA. Doesn't America still maintain a massive advantage there?
Oh, the CUE moat is absolutely real.
Okay, good.
CUDA is Nvidia's proprietary software platform that developers use to communicate with the hardware. To use an analogy, imagine if every master chef in the world was trained to only use one specific brand of highly complex oven.
Okay.
Even if a rival company builds a slightly better oven, no chef wants to use it because they'd have to completely relearn how to cook.
That makes perfect sense.
That's what Nvidia did with software developers. And impartial assessments confirm that this software stack remains the main frontier that American companies still hold firmly. It is incredibly difficult to replicate the years of development and the global developer loyalty built around CUDA.
Okay, so if we still have the chefs, so to speak, how is China circumventing that advantage?
Well, this is where Huang breaks AI down into what he calls the 5-layer cake.
Okay.
You have the physical hardware at the bottom, then system software like CUD, then frameworks, then the AI models themselves, and finally the applications we use.
Right.
China might be lagging in the system software layer, but they have a massive advantage in human capital. Huang referred to their vast pool of math and science researchers as one of their national treasures.
They just have the sheer numbers.
Exactly. Couple that raw talent with significantly cheaper energy costs. And remember, training these models requires city levels of electricity, and China remains a highly formidable competitor. They are essentially using cheap energy and massive brain power to brute force their way around the hardware and software gaps.
So what does this actually mean for you, the listener, commuting to work right now? For the last 20 years, technology was largely a global monoculture.
Right. Everyone used the same stuff.
We all used USB standards, similar internet protocols, and the same underlying silicon chips. But looking forward, we are looking at a fractured ecosystem. The smartphones, the enterprise software, and the AI platforms your family uses might look, function, and cost completely differently depending on which side of the globe they were developed on.
Exactly. And a fractured ecosystem often means slower overall global deployment and higher costs for consumers everywhere. Instead of building on a shared foundation, companies and nations are duplicating efforts.
It is a massive disruption on every single level. And, well, speaking of keeping things running smoothly, before we wrap up today's show, let's take one more quick break.
Sounds good.
Before we wrap up, a quick thanks to Old Glory, an iconic music and sports fan merch store, perfect for the techie in your life. Use promo code SNARFUL for 15% off at oldglory.com.
So looking back at everything we've unpacked today, the underlying current is a reversal of what we thought was permanent. The ambitions of meme stock veterans are attempting to fundamentally reshape physical and digital retail by weaponizing brick-and-mortar stores.
Right, a mall video game store attempting to swallow an e-commerce pioneer just to solve the physical trust bottleneck of the internet. It's wild.
Then you have a startup solving impossible manufacturing physics to bake a giant silicon chip to challenge a $3 trillion incumbent, completely rethinking how we process everyday AI inference.
And finally, the geopolitical splintering of the hardware market. The U.S. export bans inadvertently turbocharging Chinese domestic innovation, completely reshaping who builds the future and where it gets deployed. The map has entirely changed.
It really makes you evaluate your own assumptions about how the market works.
Which leaves us with a question for you, the listener, to mull over as you go about your day. We started by talking about the rules of the game being broken.
Right.
If a retail video game store can attempt to buy an internet giant, and a startup can build a chip 58 times larger than the industry standard just to run the AI we use every day, what other seemingly impossible tech rules are about to be broken in our daily lives by the end of this year?
It definitely makes you wonder what we consider impossible today that will just be standard practice tomorrow.
Absolutely. Keep your eyes open because the dots are only going to get more interesting to connect. We're here to help at Snarful, so reach out on our website if you have any more questions.
That's a wrap on today's top stories. Remember, tech doesn't have to be complicated, and we're here to help connect the dots. If you've got questions or want to learn more, visit us at snarful.com. Thanks for listening, and we'll catch you next time.